Hey folks, so in this video, I'm going to talk about the big FOMC meeting that we're about to get. And right now, I'm on the federalreserve.gov website, and I'm on the meeting calendars page. So if I just scroll down a little bit, you guys can see that on these dates right here, there are stars. So we have one for March, we have one for June. If I scroll down a little bit more, we have one for September, and we have one for December. So these meetings are actually associated with a summary of economic projections. And we actually get 4 of them every year. So we get basically one every quarter. Now, what makes these very important is that we get a lot of these projections, one of them being interest rate hikes. So let's just go ahead, let's take a look at an example of a summary of economic projections. And let's just take a look at the dot plot. So many of you guys may have heard the dot plot, but I'm going to show you guys exactly what this is. So this is the dot plot. And essentially, on the x-axis, we're looking at the time frame. So right here, we have 2022, 2023, 2024. On the y-axis, we're looking at the percentage. So this is where people think that we're going to be. Now, I'm going to zoom in for you guys so you guys can see this a little bit more clear. Oops, a little bit too much. But basically, every single dot represents a vote. And we can have up to 19 dots. So there are 7 members of the Board of Governors that could put a dot here, as well as 12 presidents of the regional banks. So that's a total of 19. But we don't always have to have 19 because sometimes we have vacant seats. So in this example, we actually have 16 dots. And for 2022, back here in March, they were saying we're going to be somewhere between 1.75 and 2. Now you can see all of these dots are kind of lined up right here. But as you guys know, that was wildly incorrect. We got the Russia-Ukraine war, inflation, proved to be sticky, and now we're in a much worse situation. So, sometimes these summary of economic projections, they can change wildly. So it's better to take it quarter by quarter rather than looking back 2 quarters. So this was just a quick example of that. Now, there is another thing that you can look at, and this one's very consolidated. So I'm just going to show you what it is. So we're going to look up projection materials 2022 in the search bar. And we're going to go ahead and click search. And then now we can see these projection materials for the most recent, the March and December meetings. And then we could go further back in time as well. So I'm going to go ahead and look at the March. So if I just scroll down a little bit, they give us this nice little table. And essentially they give us these medians and the central tendencies and the range. So if I'm just looking at the federal funds rate, for 2022 back here in March, they were expecting 1.9. For 2023, they were expecting 2.8. For 2024, they were just expecting to hold it at 2.8. So let me show you guys how this exactly changed. So here is the most recent projections. So now, based off of the June meeting, we're now projecting by the end of 2022, 3.4%, 3.8% by the end of 2023, and by the end of 2024, 3.4%. So this is a pretty interesting development because here, we increased the rates and then we pulled back. So that's very key. So based off this last report, they were expecting the Fed pivot to happen by the end of 2023 going into 2024. So, sometime within that 2024 time period, we're expecting rates to fall. So this is based off the most recent projection, but we're going to get another one here on Wednesday. So it's going to be very, very important to the markets to know where these board of governors and the regional bank presidents think we're going to go. So That being said, let's just take a look at where we currently are on the rates. So if we have this 75 basis point rate hike, which I'm pretty sure we're going to get, we're going to be at a target rate of about 3% to 3.25%. Now, unfortunately, I think based off of that last CPI reading, I'm getting a feeling that, this next projection is not going to be good. Something tells me that these numbers are going to come in higher. So let's say, for example, by the end of 2022, they're expecting something like 3.75. By the end of 2023, they're expecting something like 4.25 or 4.5. And let's say in 2024, they don't even want to bring it down. They're just going to hold it there. Then that's going to be terrible for the markets. So that is something that we really got to pay attention to. Now, also think about this. After that June meeting, we saw a massive, massive rally. And to me, that made no sense at all. Because look at this March projection. This March projection, we were expecting 1.9%. And then we come out with this new projection that says, 3.4% interest rate by the end of 2022. And we rally off that. That makes no sense, you guys. That literally makes no sense. So, if we do see another rally off of this next report, let's say the report comes in even worse, you have to ask yourself, you have to be an intelligent human being. Does this make sense? Keep in mind that these interest rates, they have a big, big effect on companies. Almost all companies, they are borrowing money in some form to finance their business. So they are paying money. They're paying more money in interest fees, especially these shorter term interest rates. And that shorter term financing, they're paying more money on that. Also, when they're doing those longer bond issuance, they're also paying a higher interest rate because these risk-free rates, the treasuries, those rates are going up. So these corporations, they're not risk-free. So they have to offer a higher yield than these treasuries for people to want to invest. So keep that in mind. And also, when these treasuries are giving higher yields, people might just want to get out of the stock market and go into the bond market just as a safer investment. So these are some of the things that happen when interest rates go up. And also when these interest rates go up, sometimes the dollar can go up too. And right now, a lot of these companies, they're facing foreign exchange headwinds. So just keep all of this in mind, you guys, that, these interest rates going up could really, really hurt the market. So I hope you guys enjoyed this video and have a great one.